Welcome to our webinar, everybody. We'll just give everyone 2 minutes to begin. Good afternoon or good morning, depending where you're calling in from. Welcome to our webinar today about understanding the Main Street Lending Program Funding Forward. Please post your questions in the Q&A only. We'll take questions after the prepared remarks. A recording of the webinar and slides will be posted shortly on our community site at realtime.inc.com, and later today we will also email a copy to participants. Briefly about myself, I'm Kassar, the founder and CEO of MultiFunding. I have advised prior administrations as well as the Federal Reserve on the business credit markets. I have a book out on Amazon and anywhere called The Growth Dilemma. And for my entrepreneur organization friends out there, I'm a proud member of GEO Philadelphia. My attorneys asked me to share a few disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is a time for all of us to be reimagining our business, thinking about what is next, as it's going to be a battle to get our businesses back growing and sustaining to where they were. In any battle, you need a strategy. Will you pivot 5%, 50%, or 90%? You need to know what your team looks like going forward. And preparing for a battle, you want to have your ammunition. In this context, ammunition is cash. And you want cash for both offensive and defensive purposes. How much cash will be required to get your business back up on a stable footing? What is the best case and worst case scenario? And where will the cash come from? And what does your future look like, and what opportunities might present themselves that you will want to consider? These are the veins I recommend that you think about the Main Street Lending Program. It has $600 billion allocated as part of the CARES Act. It is in effect until December 31st, 2020, and it is comprised of 3 facilities: new, priority, and expanded, and we're going to dig into each. It is important to understand that the Main Street Lending is not an entitlement program like PPP. These are loans, they're hard to get, not everyone qualifies, and you have to pay them back. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live. Most participating banks, there are about 400 of them, are now up and running. The list of lenders on the Federal Reserve website is not 100% complete and accurate, and the program as of this week has been extended until December 31st. It's important to understand what makes lenders tick about this program, and they have a different vantage point. If you have debt out with an existing lender and your business has been hit by COVID-19 but did well in 2019, they will be motivated, if they can, to give you an extra loan because it gives you more room and runway to survive all this. If your business is doing well or doing about flat or has a good plan going forward, you may well be able to get a new lender to take on the loan. They will be looking for strong credits and new banking relationships. And there are about 400 banks participating across the country. To be eligible, your business must be established prior to March 13th, 2020. You need to have, if you have more than 15,000 employees or 2019 annual revenue of $5 billion, you're too big. Your business has to be created or organized in the United States, with the majority of your operations in the United States. The definition of the U.S. eligibility test is that greater than 50% of your assets are in the United States, annual net income is in the United States, annual net operating revenues are in the United States, and annual consolidated operating expenses are in the United States. If you're a subsidiary of a foreign company, you can apply, but you have to attest that you will not be sending the money overseas. Eligible businesses are partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities or tribal business concerns. Sole proprietors are not allowed to apply. Nonprofits are allowed to apply, although the rules are different and not what I'm describing today. You're a developer or landlord, you cannot apply, and there are certain other speculative industries that are not considered eligible. If you're part of an affiliated group of companies, you can apply, but that affiliation has to choose one of the three structures to use: new, priority, or expanded, and apply in that and around the rules of that one. So let's dig into the three facilities, the new and the priority, to start. The new and the priority share some commonalities. They are secured or unsecured term loans. They have a 5-year maturity. The principal payments are deferred for 2 years and interest payments are deferred for 1 year. You pay 15% at the end of year 3, 15% at the end of year 4, and 70% at the end of year 5. They are priced at LIBOR plus 3. You can prepay at any time without penalty, and the fees to get in are 2%. The new facilities start at $250,000 and go as high as $35 million. If you're applying for a new facility, this is how you calculate how much you're eligible for. If you take the company of 2019 EBITDA of $500,000, let's say in row 1, in example 3, that company would be not to exceed 4 times that, or $2 million. If that company already has $500,000 of drawn, $1.5 million of drawn or undrawn debt, their potential new money loan would be $500,000. That same company in row 1 at $500,000 worth of existing debt, their potential new money loan would be $1.5 million. What's important about these loans is if you're going to have other lenders side by side with them, the other lenders have to agree to share rights with the Main Street lender in bankruptcy. However, in the normal course of business, the other lenders' rights can be senior to the Main Street lender. And these loans can be secured or unsecured, depending upon what you work out with your bank. Priority facilities start at $250,000 also, but they go bigger. They go as high as $50 million. To calculate what one of these are eligible for, you go at 6 times EBITDA instead of 4. So if you take an example of row number 3, a company with $500,000 worth of EBITDA, their maximum could be $3 million, but if they have $1.5 million worth of debt, their potential priority loan would be $1.5 million. That same company in row 1 with $500,000 worth of existing debt would have a potential priority facility of $2.5 million. What's unique about these loans is that you can refinance other debt to them as long as it's not with your Main Street lender or one of its affiliates. And in these loans, the lender's rights have to be senior with or pari passu with all your other lenders. And these loans can be secured or unsecured depending on what you work out with the lender. The next facility I want to touch on, the third one, is the expanded facility. And these loan sizes go from 10 million to 300 million, so they're generally much bigger. These are loans that you would tag along to your loan with your existing senior lender. So if you had a company in row 2 with $10 million of 2019 EBITDA, their maximum not to exceed would be $60 million. If that company already had $50 million worth of existing debt, they could get a tag along of an additional $10 million. These loan attributes are similar to the other ones, except the rights tag along with the existing lender and the fees to get in are lower. On all these loans, unless if you're refinancing debt into the priority, you cannot use the loan proceeds to pay off any debt early, and you agree not to shut down your lines of credit while you have the loan. In addition, you certify that you have reasonable basis to believe that your business will not go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including a credit card, in the ordinary course of business. You can take on additional debt obligations required for the ordinary course of business as long as they do not interfere with the rights of your Main Street lender, and you can refinance maturing debt. While you have the loan, and for 1 year afterwards, you agree to certain certifications and covenants around compensation and capital distribution restrictions. There are exceptions for this if your business is an S Corp or another tax pass-through entity that allow you to cover your tax obligations. While you have the loan, and for 12 months after you have the loan, you agree not to repurchase an equity security on a national securities exchange, and you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree not to earn more than that in any year that you have the loan plus 1 year after. If you earn more than $3 million, say you earn $6 million, you take the difference between 3 and 6, 1.5, you add it to the 3, and your compensation cap is $4.5 million. While you have the loan, you agree to make reasonable efforts to retain your employees, but unlike PPP, that is not the primary focus of this loan. Your lender will calculate EBITDA or any adjustments you consider. If it is a lender you've worked with before, they will have to do it the same way they've done it historically. And if it is a lender that you've not used before, they will have to do it the same way they have done it for companies similar to this one historically. The debt will be calculated on the date of your application, and it will include all debt, private and bank debt, as well as drawn and undrawn debt. If you have an asset-based line, the debt will be calculated based on the amount that you actually have drawn, not the amount that you could draw. How do you pick between the three? Really, if you take row 2, a company with $4 million EBITDA and $10 million worth of existing debt, they could get a new of 6, an exit priority of 14, or an expanded of 14, and they would have to decide which one they wanted to do, depending on what made the most sense for them, and they could work out with their banks. Financing strategy, my friends, is about offense and defense. One example that a company is using the Main Street for is they have a $3 million line of credit and $1 million drawn. They're planning on getting an MSLP to give them extra liquidity just in case. They would rather not draw down the entire line. Second is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. So how much money will be required to get your business back up on a stable footing? What is the best case and worst case scenario? And where will the cash come from, and how will you get it? And what does your future look like, and what opportunities will you want to consider? Those are the end of my prepared remarks. And now the moderator will open the floor. Please feel free to put any questions in the Q&A, and we'll be happy to answer them.
Thank you, Ami. We are open for questions. Does the PPP count as debt?
Yes. You're an easy crowd today, folks. Happy to answer any questions that you might have. Don't be shy. If you want to raise your hand, you can also speak it. That's okay. You can raise your hand in the chat box if that's more comfortable for you.
So EBITDA as of December 2019 and debt as of the day of the application, correct?
Correct.
Are current bank is not participating in the MSLP, and we have a line of credit with a personal guarantee with them. We are meeting with another bank about the MSLP. Will they also require a PG?
In 99% of the cases we're working about 40 of these across the country. The lenders are demanding a PG. Feel free to share your questions, folks. Questions going once. Questions going twice. Okay, so we thank you so much for joining us today. And if we can ever be a help, please feel free to reach out. Take care now. Bye-bye.
Thank you, Ami.